Today I'm joined by Randall Janicki, our Head of Australian Equity and our Portfolio Manager for the T. Rowe Price Australian Equity SMA for MIQ investors. Thank you for joining us, Randall, on this wet day. It's been a very volatile start to the year. We've seen war in Ukraine, a Fed very aggressively hiking. How have you seen Australian equities in this environment?
So it's been fascinating, Jared. I mean, obviously a lot going on in markets locally and globally. But what's interesting is that the Australian market has been incredibly resilient. So for the March quarter, the Australian equity market rose by 2.24%, outperforming pretty much every other global equity market. And if you stand back and try and understand the reasons why, I think it's important that you look at the Australian market as being more of a value market, and value as a style obviously has been the style that's performed and outperformed very strongly over the last 3 to 6 months. And that comes about from the fact that the composition of the Australian equity market really is dominated by banks, miners and energy stocks. It's roughly half the market. And obviously commodities have been strong over the period of time, and that's why that part of the market has held up really well. And then rising rates also helps banks. So that's what's really been driving the Aussie market. But a lot of risks out there, a lot of cross currents. And I think the challenges for equity markets locally and globally will continue to be there over the course of 2022.
Very interesting, and it's interesting to see that value having that stronger role in the Australian market. And coming back to being a quality growth investor, how's that been in terms of your positioning?
So, I mean, it's been tough, definitely, for quality growth managers in this environment. The way that I simplify what really drives markets is that there are two key factors. There's interest rates and there's earnings. And so obviously we're in this environment, and we have been for the better part of 6 months now, where interest rates have been rising. And when that happens, you tend to find that you have a derating within equity markets. And the part of the market that derates the most is the higher growth part of the market. So we've seen that. So a lot of quality growth stocks have really underperformed. They've fallen somewhere between 10 to 30+%, depending on the stock. And so that's been a challenge for us from a style perspective. But I think more importantly, it's about what's coming next. And what comes next, I believe, is a slowdown in earnings as interest rates rise to combat inflation. And when that starts to really play out in markets, I think we're going to have a different dynamic where I think value is going to come under pressure when we get earnings downgrades there, and quality and growth will do well. So right now we are positioned in quality growth and really looking to take advantage of, we think, some oversold opportunities in that part of the market.
Fantastic. And then with that sell-off of growth, I'm guessing that's presenting some really fantastic opportunities for you. I mean, where are you deploying some of those opportunities?
So there's a few interesting areas right now. So healthcare is one. So we're overweight the healthcare sector by about 500 basis points. So key positions there are Ramsay, ResMed, CSL. And we've seen a lot of underperformance in the healthcare names, given some of those factors I touched on previously. So healthcare is one area. I say staples is another. The supermarket players in particular, we think, stand to benefit from higher inflation that's coming through their sales numbers. And then the other area, more at the growthier end rather than the quality end that I've just described, is in consumer discretionary, where you think of names like Aristocrat, names like IDP, names like Domino's Pizza, really have been sold off quite heavily over the last quarter. Really at valuations as attractive as we've seen in 5 years. So that's another area where we are deploying more capital.
Mm-hmm. And you mentioned, potentially towards the end of the year, we'll see growth come back into favour. Is that still the view, or do you genuinely believe there may be a change in regime given the strong performance of value at the start of the year?
I think overall, over the course of the year, it's probably going to be a nil or draw from a style perspective. I think value's had a good start because interest rates have increased a lot and put pressure on valuations for growth companies. But as we move forward and interest rates start to bite and the economy slows, and that's what's going to be required to get inflation under control. Demand has to slow. It's not just supply chain disruptions that are driving higher inflation. It's also because we juiced up demand during the pandemic by doing too much on fiscal and monetary policy. And as rates rise, liquidity gets withdrawn, earnings will come under pressure. We think earnings will fall. We'll start to talk more about recession. And that's a bad environment for cyclicals and value stocks. And in that environment, which I think will come in the second half of this year, I think value will underperform and we'll see a stabilisation in interest rates when markets worry about a slowdown and recession, and that will be good for growth. So I think in the second half of the year, quality and growth will outperform value.
Very interesting, and clearly a very fascinating market right now where we're seeing value and growth really battle it out. And I think it's a great opportunity for an active manager to take advantage of a lot of these opportunities. And for more information about our approach, please contact your local relationship manager. And thank you, Randall, for joining us.
Thank you.